And I'm just going to go through a little bit of the guidelines and then introduce Gerald Stewart as well to answer some questions from everybody. So we have two different renovation programs. One is a conventional renovation and the other one is a government-backed renovation. The conventional renovation is Fannie Mae. The government-backed renovation program is called FHA 203K. So we're just going to kind of run through them both, just a Cliff Note version, just so you know they exist. The funds for down payment and closing costs can be gifted. Credit score requirement for our conventional program, in the guideline, it says 620, but why I asterisk that to a 680 credit score is that we typically cannot get it through our underwriting desktop automated system. So while people will question me saying, well, I have a 640 score and I read you can go down to 620, you can if it gets through the system. So typically we're going to be looking at a 680 score. Also, total repair cost cannot, or the value of the property, we take 75% of the value. So if you have a $400,000 value, 75% of that is $300,000. The repair cost cannot exceed $300,000. We have never run into that rule on this, so it's just something I point out, but we've never had an issue with it. The homeowners must reside in the property for 1 year after the work is complete, but after 1 year, they're free to move, or if they want to buy a different property, that's fine. It's just 1 year required to be owner occupied for a primary residence. The desktop underwriter will determine if the client needs reserves for the property and other properties owned, so we'll work with them on that. And if you're qualifying with a pending sale, like on a home you live in, the borrower is going to need some reserves just to make sure they have enough funds to pay for both mortgages. A non-occupant co-borrower income is allowed to qualify. So for example, I recently had a nurse who was graduating, but they wanted to buy now. She had no income yet, so her mother and father co-signed. And then once she graduated, we were able to refinance her about 8 months later and get the parents off and then use her income from her nursing job. So we can use any non-occupant co-borrower to qualify for these programs. And home style for 3 and 4 unit properties does not require any self-sufficiency test. That's something we'll talk about with FHA, and I'll explain what that is. And then we always have a 10 to 15% contingency for cost overruns when we're doing these projects. So if you use the contingency, that's fine. But let's say, for example, your budget was met and you did not use the contingency, you don't lose it. It goes back to principal reduction. And we can also roll in up to 6 months of mortgage payments if the property is not habitable and if the appraised value supports these payments being rolled in. We do try to do that often on big projects just so there's not a financial hardship for the borrowers, and I walk through that opportunity with them. So that's a little bit about home style. Our next program is the FHA 203K. The funds for the down payment and closing costs may be gifted as long as the credit score is over 640. The 620 to 640 credit score, they're not allowing gifts at this time. FHA modified their guideline recently due to COVID-19, but we can still work with credit scores down to 620, where many lenders have changed their credit score for FHA up to 680 or 700, which really isn't a benefit to our FHA borrowers. Also on FHA, you can have a non-occupant co-borrower as long as it's the family member, and they would be on the contract and on the title. For single family home, if you have a non-occupant co-borrower, 3.5% is allowed. If you have a non-occupant co-borrower on a 2 to 4 unit, FHA has a rule in place that they require 25% down. We're just pointing that out in case we have a lot of people buying to add up to the down payment. If you do not need any cosigner and you're just buying on your own, FHA has a phenomenal down payment, only 3.5% for 1, 2, 3, and 4 unit properties. So they have the low payment available on any property. We can use the future value to do these loans because we're basing our value on all the improvements you're doing. If we're doing a refinance, we also do an as-is valuation. So there's one extra step on a refi. The primary borrower must occupy the property for 1 year after completion, just the same as homestyle. And 3 to 4 unit properties for FHA, the borrower has to have 3 months of their own principal, interest, taxes, and insurance. Those are called reserves. That can't be gifted, but that would be the only thing the borrower needs on a 3-unit. They can be credited the seller paying the closing cost, and they can be gifted the down payment. They would just have to have 3 months reserves. So this is one of the most aggressive programs out there available for people that want to get in with a low down payment. The self-sufficiency test on FHA can confuse everybody. It confuses my borrowers, it confuses my realtors. What this means is on a 3 to 4 unit property, they're going to ask what the rents are for every unit. Knowing you're going to live in one, we understand that. We still want to know what the market rent is for all of the units, like if it's a 3-unit or 4-unit. We then take that total of market rents based on the improvements and use a factor of 75% to calculate a total. As long as the mortgage payment is less than that, that property qualifies to move forward. I often get questions like, well, I'm living in a unit, you don't need that. We need it for this test that FHA does. For income qualifying, we can only use 2-unit rents if you're buying a 3-unit, or 3-unit rents if you're buying a 4-unit. So I'm not trying to confuse anyone here. I'm just trying to say there's a couple extra steps that I'll take with you and your realtor on a 3 and 4 unit and make sure that these market rents meet these self-sufficiency tests so that we're going to get into a property with a full, proper approval. Also for FHA, 50% of some material funds can be released once we close to your general contractor for items such as windows, flooring, cabinetry, and roofing, because those are usually expensive and we want to get some material money to the contractor. And that's where the HUD consultant comes in. He will help with that first draw process, and we're going to talk about his role in a little bit. The next, what we're going to do is talk about eligible property types. We can do 1 to 4 family units, condos that are warrantable. So on our home style condominium, the HOA provides a letter that the renovation project would be approved by the condominium association. We need that prior to closing. And then for 203K, we do 1 to 4 unit buildings. And if you ever do a condo, you would also need the same letter. The problem was FHA, if anyone knows this rule, it doesn't come up a lot. FHA does condos up to any amount of units. FHA 203K has an overlay on their guideline that the condo building can only have 4 total units. So if you're in large metropolitan areas, that's going to knock out probably 70% of all the condos out there. And when you start to do buildings that are only 4 units, they're self-managed by just the homeowners, and they normally don't have FHA approval. So it has to be FHA approved, and it can only be 4 units. So what I guess I'm saying here is we don't do many FHA condos. We basically do them under our conventional program. So condos are done, but under the conventional program. We do townhomes. Those are treated as single family. Those can be done on FHA or home style. And we can do any conversions of multi-unit dwellings. So I have a 2-unit right now that my borrower is buying, and he's just going to be using it as a single family home, which is totally fine. It's just decreasing from 2-unit, making it 1 large single family. Conversely, we can take a single family and increase it to a 2 or 3 unit as long as the zoning is in place prior to closing. A tear down is allowed on either program as long as the existing foundation remains in place. And you can add on as well, like you can, build out and do new foundation as long as the existing foundation remains. FHA 203K also has a great program for mixed use properties. So you can buy like a 4-unit building that has a commercial space on the main floor. For example, like if there's a State Farm office on the main floor and then there's 3 residential spaces above, you're allowed to use this program with 3.5% down on a commercial building, which is unheard of, as long as the commercial space is under 49%. There will be no money given to renovate the commercial space, but you will get money to do any exterior work, roofing, tuck pointing, garage, and any money can be used for the residential units to increase the value of the rents if you would like to update them. Homestyle also has a mixed use program, but it maxes out with 2 units because the owner, it has to be owner occupied, and the owner also has to own the business. So it's more for someone if they're like, we had a lawyer buy a 2-unit property with our conventional program, and he lived in the property on the 2nd floor, and then his office, his law office was on the 1st floor. So we have a lot of opportunity out there for your buyers. Ineligible properties are co-op units, non-warrantable condos, And then homes that have never been completed on 203K, they don't allow. They do allow that on our home style. So I'll match up the program with the borrower based on what they're doing.